Hello and welcome, everybody. I'm Vern Cushenberry, Chief Investment Officer, and I'm back with another quarterly market update. And it's been quite a volatile quarter, so it's time to hit the pause button and check in. I always like to give my audience the bottom line up front so you can tune in and tune out at your convenience. And the bottom line up front is that COVID shut the global economy down for a period of 2 years, and we're still working through that. And we had historic stimulus measures to fight off some of what could have been the worst of the economic response to a pandemic that was more severe than anything we'd seen in almost 100 years. And the market is still normalizing. And those stimulus measures caused an economic boost for a while that resulted in inflation. Now we're seeing the Federal Reserve fight that inflation with aggressive interest rate raises. That affects fixed income portfolios. It affects the markets. Investors were exuberant and the markets shot up. And now the economy looks like it might be rolling over a little bit into a recession as the Federal Reserve fights those inflationary measures. And bottom line up front is that the market is normalizing. This is nothing that we haven't seen before, despite what it might feel like when you open your quarterly statements. We need to offer some historical perspective because we have been here before. We have seen similar markets in the past. And what we know is that markets tend to serve as a forward-looking mechanism, meaning they discount the future. So the markets will bottom before we see the worst of the recessionary impacts. So that's the bottom line up front. I end every one of these quarterly videos with a message that says reach out to your financial advisor and let's make sure we've stress tested your plan, because if we've done that properly, you are still on course. There's nothing about this current market that would significantly affect a well-designed financial plan. So having said that, let's wonk out a little bit and dive into the numbers. This is what I enjoy as a finance guy, as a chief investment officer. I like to look at the numbers. And in the last quarter, the markets declined a little bit. Year to date, we're down 25%. That's bear market territory. That's what we would expect to see going into a recession. Typical recessionary drawdown is somewhere north of 20%. And we've experienced that many times in the past. So this market doesn't necessarily look any different than what we've seen in the past. From a valuation standpoint, we have now corrected so that our price to earnings ratio, if you look at the market, is about 15 times. That's below a historical average. So approaching something that you might think of as fair value territory. We had gotten a little bit above conventional measures of fair value there. Again, as governments around the world really increase stimulus measures to fight the COVID response. So what I want to talk to you a little bit about today are three things: inflation, interest rates, and recession. So let's look at a couple of slides that I cherry picked out of our master deck, and I'll give you a little bit more detail. First off, talks about recession, and I want you to focus on the right-hand side of this chart. Over here, we have the year-to-date return of the S&P 500. That's the green line. And in the gray line, we have earnings growth. So we're going back to December of 2021 here, so not quite a year ago. And you can see that corporate earnings, they've increased by about 5% during that time. Now, in a recessionary environment, you would expect corporate earnings to decline. We have not yet seen a significant decline. It looks like the peak was maybe earlier this year, and we've seen a slight decline, which is why you might have seen on the news some of the pundits espousing that we had already entered a recessionary environment. Maybe. It's not severe by any stretch. But what we have seen is an investor response, and that investor response has affected the price of the markets. So that's measured here in the green line, where we see the S&P 500 declining significantly, 25% in that time span. I mentioned that the markets are forward-looking, meaning they're a discounting mechanism. They behave based on investors' expectations of what they think is going to happen in the future. So investors think a recession is coming. When that happens, we're likely to look back in time and observe that we've already experienced the lows. And if you do exactly that, if you look back at history, that's the way the markets have performed in the past. So have we reached the bottom? I don't know. I don't have a crystal ball. I can't predict the future, but I do know that this is unfolding like we've experienced in the past. So investors are smart to be mindful of that. This next slide shows inflation. It's still, the headline in the financial markets. This is an environment like we haven't seen since the early 80s. So we don't have a near-term template for how to manage through this. Our Federal Reserve market regulators, they have the tool at their disposal. The primary tool is the adjustment of interest rates, and they are using that tool aggressively. And we expect inflation to moderate, and we are seeing some signs of that. But they have communicated to the markets that they will be aggressive until they see inflation begin to moderate, and that's a good thing, despite the turmoil that it creates in the fixed income and your fixed income accounts and your equity accounts. That's a good thing. We expect the markets to normalize. And remember, a normal market, on average, has generated a 9 to 11% rate of return going back a century. That's what we expect going forward, although the price you pay for those returns can be short-term volatility. So I mentioned that inflation is the headline, and interest rates can be viewed as the primary tool of the Federal Reserve. And this slide talks about how the markets have been reacting to an increase in interest rates by the Federal Reserve over the last year now. And it affects the whole fixed income market. One of the key fundamental building blocks in the field of finance is that interest rates move inversely with the price of bonds and other fixed income instruments. I teach finance down at the University of Missouri here in Kansas City, and this is one of the core concepts that I was talking to my class about just this week. And if you're not entrenched in the field of finance, this doesn't necessarily make intuitive sense. So it's important to pause a little bit on the slide, because when you do understand the way the fixed income market works, well, then an increase in interest rates, which causes a corresponding decline in the value of your fixed income securities and the number that you see on the bottom of your monthly statement, you can take that with a grain of salt and maybe breathe a little bit easier and sleep a little bit easier at night. So let's look at what's been going on in the fixed income markets. As the Federal Reserve has raised interest rates this last year, what we've seen is that the price of those securities has declined, in every asset class. And here we're parsing the fixed income universe by, 8 or 10 different categories. We're looking at US Treasuries and different maturities, 2-year, 5-year, 10-year, 30-year, so on and so forth. And then we look at corporate bonds issued by your big Fortune 500 companies like Microsoft, GM, Coca-Cola, so on and so forth, and also municipals, mortgage-backed instruments, and other asset-backed securities like car loans, credit card loans, and such. And they're all red. Every single one of these asset categories are red this year. I want you to focus on this line up here. Let me clear off some of those drawings. I want you to focus on this line right here. The 10-year Treasury. Remember, these securities right here are issued by the United States government, so they don't have any default risk. If the United States government were to default on its debt, I guarantee you have bigger problems than the amount that it looks like you're losing in your investment portfolio. So while a 10-year Treasury is down 16.85% on the year, look what has happened to the yield. The yield has gone from 1.52% to 3.83%. So even though the price of that security has declined by 16.85%, because the yield has more than doubled over the life of that security, investors can expect to recoup their losses and be made whole So from the perspective of your financial plan and the goal that we're ultimately targeting, most of the time that's retirement for the clients that we work with, you are in the same place that you were and just as likely to reach your end goal because there's no default risk there. Now, for some of these other corporates and other securities, there are nuances that come into place. If the recession were to be historically severe, then some of those companies might default. And we saw that in the great financial crisis of 2007, 8, 9, but we haven't seen any hallmarks or indicators that the economy is about to go over that type of cliff. So just know that fixed income prices move inversely with yields. We lose value in fixed income securities when interest rates increase, but we get the benefit of that increased rate over the life of the security, and that should help us all to be mindful of going forward. Lastly, I sat down with my team this quarter. I always sit down with my team and I ask them, what are you hearing from your clients? What are you hearing from investments? What do we need to communicate? And being a good investor is all about revisiting the timeless principles that help us capture those returns over time. And this is what we call the asset allocation quilt. Helps give us an understanding for how major asset classes vary over time. I like to joke that being a portfolio manager is a game of woulda, coulda, shoulda. We're always looking in the rear view mirror, faulting ourselves for where we should have been invested. And if we could see around corners and forecast the market with perfect insights, we would have had all of our money in commodities this year. But we don't have a crystal ball and we can't see into the future. So we take a more measured approach. And rather than investing in commodities and seeing our return fluctuate wildly from first place this year would have been last place for a long stretch of time between 2012 and 2016, we invest in a more diversified portfolio. And that diversified strategy has typically captured those market returns over time. And you can see it's never first and it's never last, fluctuates in the middle, and this is a well-diversified portfolio of stocks and bonds, and we call that our asset allocation portfolio. This year it's down. It's down 19% because both fixed income and equities have declined. The only up markets year to date have been commodities and cash. Everything else is negative. There has really been no place to hide. But like I said at the top of this little video, this is the process of the markets normalizing. We expect to come through this. So I will end this video with the same message I always end this video. Reach out to your financial planner, update that stress test and scenario analysis. I don't expect anything that we're seeing in these markets to have derailed a well-designed financial plan. So thank you for your time. Please give us feedback. I love hearing from our clients. It helps me design these videos and give you information that is useful and keeps us on track. So until next time, I'm Vern Cushenberry, your Chief Investment Officer. Thank you.